I want to welcome you and thank you for joining us today for our presentation on the One Big Beautiful Bill. So we're going to be talking about that. Hopefully you're in the right place and that's the webinar you signed up for, or you thought you signed up for today. But we'll be talking about it today, and we'll dive in a little bit further in the bill, but also look at it from a tax and financial planning standpoint. So we will get started right away. There'll be time at the end for questions, so don't worry about that. I'm Carolyn Powell. I am the Director of Development here at the firm, and I'm going to be your host today. So I'm just going to touch on a couple housekeeping things. On the right-hand side is a toolbar. In there, you should see handouts that will have a copy of today's presentation if you want to grab that, and also the full bios of our experts today. Also, too, there is a question section. Put anything in the questions, anything you want to have answered. We'll try to answer questions throughout the presentation and then also at the end, so just stick those in there. And then also too, at the end of the presentation, we will send you an email. One will automatically come to you as soon as you log off for a quick exit survey. Again, in there, just give us the feedback of how the presentation was today, if you got what you needed out of it, if you'd like to set up a meeting with our experts and give us any feedback, you can do it there. This afternoon or tomorrow morning will send you an email from myself with a copy of the recorded session, the handouts, presentation, and give you everybody's contact information again. That way, if you want to share it with somebody or want to go back and listen to it, you'll get that this afternoon or tomorrow morning. So without further ado, I just want to keep moving along. I want to introduce our two presenters today. Lisa Mrkall, many of you know her here at the firm. She is a partner CPA PFS. And Lisa's been with the firm for over 10 years, and she works with our small business clients and individuals. And the PFS is Professional Financial Specialist. Our special guest today is Nicholle Overkamp. She is the CEO and founder of Wilcox Financial Group. She's a retirement planning specialist and financial advisor. So I'm going to hand it over to Lisa to get us started.
Great, thanks, Carolyn. Good afternoon, everyone, and thanks for taking the time to join Nicholle and me today. We know when it comes to taxes, uncertainty can be one of the most frustrating challenges for our clients face. And right now, we're certainly in a period of very significant tax uncertainty as we watch the progress of a sweeping piece of legislation, this One Big Beautiful Bill. So this bill represents one of the most ambitious tax reform efforts we've seen in recent years. So it has not yet been signed into law. I will probably keep repeating that just so everyone knows that they're not the final rules. But it has passed the House and it's generating substantial conversation and concern, especially for our middle income and high income earners. So we felt it was important to get this information to you now and not later. It's exactly why I'm excited to partner up today with Nicholle, and she'll bring us some really helpful insights and tools to navigate your personal finances during these very uncertain times. We do want to say that as we go through the presentation and the content today, we have a lot to cover. We will pause for questions and some feedback, but please take the time to insert any topics that you'd like to see us cover in the future, whether it's business related, tax law changes, personal, estate planning changes, anything financial planning related, any way, shape, or form. Please insert those topics into the question section, and we will do our best to cover those for you in the near future. All right, so I thought it would be helpful to set the stage a little bit and go through a brief timeline, as I think would be helpful to frame this conversation here for the next hour. So a big reason why we're here today is because of a piece of tax legislation back in 2017 called the Tax Cuts and Jobs Act, or the TCJA, passed during President Trump's first term in office. For tax geeks like myself, can't help it. These are very exciting, interesting times when they passed the TCJA in 2017. That was the first major piece of tax reform since 1986, so about 30 years before. So the TCJA actually only took about 49 days from when it was introduced in November 2nd and became law very quickly on December 20th of 2017. So it was quite the flurry of activity. I'm sure many of my fellow CPAs out there and certainly my coworkers can recall those very fast and furious days at the end of 2017. So very fast from start to finish. We're kind of in that same boat now where things are pretty fast and furious. So with the expectation of this being on the president's desk on July 4th for signature. So the TCJA contained numerous tax provisions, including significant tax cuts that are actually set to expire at the end of this year, 2025. So if the law does not change, we could revert back to the old law, which was when tax rates were higher. And certainly many of those tax provisions were not in place. But since then, we've had an election, obviously, and the results of the election included the Republican-controlled White House, as well as both chambers of Congress. And tax policy for them is very, very much on the agenda, as we've heard. So almost a month ago now, towards the end of May, the first round of tax legislation was passed by the House, known as the One Big Beautiful Bill. That was on May 22nd, and so now it's on to the Senate. The Senate has begun formal consideration of the reconciliation package and the Senate parliamentarian. So that could result in several major provisions being affected. GOP leadership aims to resolve differences and clear this bill by July 4th, as I said. And the Senate version, I was going to say could be delivered any day now, but as a matter of fact, just last night, the Senate Finance Committee chair unveiled their version, which I'll cover a little bit about later. So we do have some up to the minute changes going on here that we'll present today. So as most things go in Washington, we expect many changes to occur before the bill becomes a law. And we have about 6.5 months until the end of the year to see what will happen to the fate of the TCJA. So today's session is not just about what's in the bill, but how we as tax professionals and financial planners can start preparing all of our clients now. So we appreciate you being here. I think it's great that you're engaged and want to know how to plan for this coming year. So even though, again, this isn't the final legislation, it's the early stages, it's planning now is going to help any kind of last minute planning decisions if the bill were to pass in the fourth quarter or right before year end, which we don't expect to happen, but we've been surprised before. So it may be too late by then to make any planning moves. So Nicholle, I'm going to pass over to you for your feedback there and what we've covered so far.
Of course, and I am a big fan and advocate, and I know you are as well, Lisa, is being proactive. So the more that you are proactive and prepared and take this collaborative approach to your planning with your accountant and financial advisor, the more opportunity you're going to find for yourself. And so if you really wait until a week or two before you file or filing an extension in the next tax year, you really do give up some opportunities that we want to cover with you.
All right, so I took a couple key provisions of the TCJA just for some historical perspective. This is just broken out into some of the key areas here: individual, estate and gift, and business taxes. And so as we'll point out today, many of the proposed changes could really directly affect your take-home pay, investment strategies, retirement planning, and estate planning. So there are several provisions, particularly for high earners, that if passed could take effect retroactively or as soon as January 1st of next year. So again, most importantly, proactive planning can make a huge difference in minimizing future tax liability. We always aim to be a step ahead for our clients, not reactive, but just very strategic. So this presentation is our way of helping everybody stay informed before the headlines become a reality. So we have a few possible scenarios which could play out. If you could just go back one slide, I just want to have the possible scenarios there laid out on the bottom section there. So what could happen? Not likely at all, but the TCJA could just simply expire. Anything that wasn't a permanent provision could go back to, could revert back to pre-2018. That SALT cap could go away. We're going to get into that a little bit later. Personal exemptions could come back. The standard deductions would be reduced. Tax rates could go back up and so forth. So not likely at all to be the case. The president has an enormous goal to get the TCJA extended, or at least some of it. Another possibility is just to extend the TCJA, kind of kicking the can down the road temporarily or punting until a later time. Very costly, to the tune of about $4 trillion, and also not terribly likely in terms of funding those cost offsets. So the TCJA could also be made permanent. Kind of also unlikely with the current margins in Congress, and again, just that cost of having about the $4 trillion level, so key takeaway there. So most likely, I think in our estimation is that the TCJA could be extended in some part with some adjustments, and so that we have this new proposed bill. All right, so I'm sure I speak for Mrkall when I say that we both feel really strongly about staying on top of this, even from these very early stages, and that it's definitely of great interest to our many clients who this will affect in terms of planning, getting your initial income and tax projections set up with us, both of us to be ready for the future tweaks in the tax bill. So establishing that really good benchmark to start with here. So I'll go ahead and cover some of the key individual provisions of the bill, the one big beautiful bill, and some quicker than others to be able to spend a little bit more time on some of the key areas we think will impact a lot of you. So as far as the tax rates are concerned, what the TCJA did when it passed in 2017 and beginning in 18 was to lower the income tax rates across the board, creating a 7-bracket structure, the lowest being 10% and the highest being 37%. So these rates were temporary with the TCJA and are set to expire at the end of this year. So that would mean that those brackets would start at 15% and go all the way up to 39.6% for the highest earners. So the new tax bill is proposing to permanently extend the individual tax rate structure, locking in those lower marginal rates, preventing that major tax hike on individuals and pass-through business owners that otherwise would occur due to the sunset provisions. So staying in that 10 to 37% range. So this definitely makes planning easier when we hear the word permanent. Financial professionals like Nicholle and myself, it makes things a lot easier, for planning when we have that certainty. So certainly with retirement planning, Roth conversion strategies, Nicholle's going to be covering those. Certainly affects middle income earners too, avoid being pushed into those higher brackets. Retaining that 37% bracket at the highest rate compared to 39.6%. It even affects our small business owners operating those pass-through entities, especially when combined with the Section 199A continuation. So we'll talk about that later too.
So just financial planning notes to take into consideration as we expect the next 4 years to remain in a relatively lower tax environment. To start really thinking about Roth conversions. So if you are retired or you have a lot of pre-tax money saved and maybe you're in a lower income year or lower income years over the next 4 years, start thinking about converting some of your pre-tax money to Roth. This has especially been important for some retirees that we're working with where we want to try to avoid a huge tax bill down the road when you're going to need to take required minimum distributions in your 70s. Prior, school of thought has been just defer, defer, defer. I don't want to pay taxes, but you want to pay less taxes over time. That is always the goal. So start taking into consideration Roth conversions of those larger accounts. And what we've been doing is collaborating with your accountant so that you're staying within certain tax brackets. So over time, you're paying considerably less. Another thing to consider as well is pre-retirement income smoothing. So really what that term means is to just start paying attention to how you're saving. So depending on your tax bracket now versus what it may be later, instead of maximizing pre-tax 401k, if you have many dependents, children, you might want to start considering what it looks like to do Roth 401k or taking that and dividing it into 2 different strategies and making sure that you're just paying attention to not only the tax savings today, but what everything looks like holistically and down the road too. So these are times where taxes are most likely considerably less. We want to take advantage of that. And then if you have an inherited IRA and you are part of the newer rules where you need to spend those IRAs in 10 years, that's another thing that we want to take careful consideration with over the next 4 years here. And do we want to increase distributions perhaps while you may be in a marginally lower bracket as well? And then another couple of points is harvesting some long-term capital gains. I know we took advantage of a lot of tax loss harvesting in Q1 of this year with all of the market volatility. But again, depending on where you are tax-wise this year and again over the next 4, just some things to keep on your radar with big capital gains, or if you do have some market losses, depending on what's been going on, to really take advantage of capturing some of those and paying attention to those nuances.
So we have our first question from the audience, and it's a really good one. It's what are the main benefits of this new bill? Who are the notable winners and losers when it comes to the tax bill as it stands now? So that's a great question. So if no action is taken, about 62% of taxpayers would see a tax hike at the end of this year. They are not the winners, but continuation of the status quo is this year's tax design. So for other folks, they'll see a tax cut on top of that, mostly from these new ideas like no tax on tips income for most employees. I'll actually get into that in a couple minutes. The deduction for overtime pay, I'll cover that in a little bit too. That premium portion of overtime, potentially not taxable. There's going to be a new deduction for seniors, which is part of the president's campaign, and no tax on Social Security, so a version of that. There's also going to be a deduction for certain auto loan interest items, leading to an after-tax increase in after-tax income. So there might be tighter rules coming down the pipe to help offset these tax cuts, like tighter rules with the tax credit, the premium tax credit, and so forth. So more to come on that, but great question. So the standard deduction. So the standard deduction is another hot button item with regard to the TCJA having doubled them, and if it expires and it sunsets, those going back to the the pre-TCJA amounts. So the bill, the One Big Beautiful Bill, it permanently extends the increased standard deduction with further increased amounts for 2025 to 2028. So one note on itemized deductions, there's nothing that we're seeing that would indicate that those famous miscellaneous itemized deductions would be returning, that those certain collection of deductions subject to 2% of your income, like tax prep fees, investment advisory fees, safety deposit box rental fees. So those are all not coming back based on everything we're seeing. Seniors would receive an additional $4,000, even if they do itemize, subject to income thresholds, partially addressing, like I said, the campaign promise to make Social Security benefits not taxable. So this doesn't really directly correlate to the standard deduction, but even if the seniors do take the standard deduction, which many do, they would still get this additional $4,000 on top of it. So there are some income thresholds there: $75,000 for single filers, $150,000 for those married filing jointly. So that's one of the new provisions in the One Big Beautiful Bill.
And then for those of you who are taking advantage of the standard deduction versus the itemized deductions, and if you are charitably inclined, I've had some conversations with clients that are frustrated that they are giving a lot to charity, or they have a lot of medical bills, high interest on their mortgage, but they're like just within $1,000 of the standard deduction versus all their itemized deductions, and they feel like they're getting gypped a little bit. So something to take into consideration, especially with charitable contributions, is doing what is called charitable bunching strategies. So what we've done with some of our clients is strategically planning out over the course of a few years to toggle back and forth in alternating years where you take the standard deduction, and then maybe in the other year you take the charitable contribution itemized deduction. So what you can think about doing is taking a few years worth of charitable contributions and doing it all in one year to maximize your ability to itemize over that standard deduction and take advantage of charitable contributions. There's also vehicles like donor advised funds where you can put the money in one lump sum, itemize, and then be able to still, over the course of years or many years, actually contribute to charities as well, because I've gotten some concerns depending on the size of the money going in. I don't want to give it all to one spot, or I want to stretch it out over time. So there's some nuances there, of course, but I just wanted to make mention of that because it's important to think about how you can still maximize different parts of the tax system. And another thing as well, for those of you who have those pre-tax IRAs and you need to start taking distributions, especially if you are over the, depending on your birth date, 70 and a half, all the way up to 73, and you don't need that money, you don't want to increase your tax bracket. You can actually just do qualified charitable distributions. So you can take right from your IRA to that qualifying charity and avoid the taxes coming out of your qualified accounts and still be able to do those charitable contributions as well. Same thing with any highly appreciated asset. So a lot of things that we can do to still get to the end game, but reduce your tax bill.
All right, so we will continue on with a couple more key individual provisions. I'm going to skip over the first two. Mortgage interest, that's still very much up in the air what that limitation will be, whether or not it's reverted back to the $1 million limit or it will stay at the TCJA level of $750,000. But a lot of people are asking about this no tax on tips. So it really gets a lot of attention from all different levels of taxpayers, depending on what your income is. This could be very beneficial. So what does this mean? So it could mean more take-home pay for workers who rely on tips, and those who qualify can get an above-the-line deduction, meaning that you don't have to itemize your deductions to claim it. So it's before all of the deduction standard versus itemized takes place on your tax return. So the way things stand as of right now is that the employee still must include the tips as income, but then they get a deduction for it at the federal level. So tips for tips earned during the qualified period. So this may not be allowed for state purposes. So more to come on that, can get kind of messy. So this is just the federal law at this point proposed. It's only going to be for 4 years, 2025 to 2028. And these are for tips that are voluntarily paid to a worker. So these are going to be employees in restaurants and salon employees, for example. So that actually leads me to a question that we get asked a lot. I think it's a good time to cover that, and that is, should I be adjusting anything in my withholding at this point right now? So that's a great question. I think that applies very much so because we still have 6.5 months of the year to go. You can stretch that change in withholding out for a lot of the years still, but we're saying no. Not at this point, since none of these changes are permanent yet. If you are, though, anticipating a higher tax bill in 2026 or a bonus this year, now is a great time to have us reach out to us, have us run a projection and consider adjusting withholdings or estimated payments to avoid surprises on things that we do know for sure will be happening.
And just a quick note here, some things that actually we've been dealing with on mutual clients is if you are someone who has vested shares with your company this year that are happening, or you're getting stock grants, that is a great time to assess and make sure you have been withholding enough throughout the year, really to Lisa's point, just to avoid any surprises. So really important stuff.
Definitely. Great point, absolutely. No tax on overtime pay. Another very commonly asked about tax provision in the bill. So this would create an above the line deduction again. So whether or not you're itemizing for overtime pay. So just the overtime component, just that premium portion, the overtime portion for hourly workers, just like no tax on tips. So this is only going to apply again for 2025 to 2028. A quick note on expanded use potentially of 529 accounts. Could become useful for in connection with elementary, secondary, or homeschooling, as well as post-secondary credentialing expenses. So like many provisions, more withdrawals may mean more reporting, more scrutiny, and so we'll definitely keep an eye on that.
Yeah.
So I was just going to mention these mega accounts. This is something new. Again, a lot could change here, but it's a new financial account targeted at children under the age of 8, allowing for tax deferred growth and limited use of the money that grows in there. Distributions only between the ages of 18 and 25, potentially for the purposes of encouraging entrepreneurship, home ownership, financial security, and those withdrawals would are as proposed would be subject not to ordinary income, but to long-term capital gains treatment for those distributions. The federal government is looking to contribute $1,000 to any child with these accounts born between January 1st of 24 and 12/31/28. And then parents can contribute $5,000 a year for these children under the age of 8.
And just a quick note too on a lot of the changes that they've been making and modifying to the 529 plans to allow for outside of just qualified college costs to be able to use it toward the loan repayment, secondary school, and a few other things. This is if you are a New York State resident and you made the New York State deductible contributions into the 529 plan. Federally, this has changed, and they're looking at further changes and modifications, but New York State didn't adopt that. So you could have recapture on your New York State income taxes for those 529 plans. So a lot of you in New York State have been maximizing that deduction. And then another little nuance too that has been coming up in question with the 529s, if you are using it for qualified college expenses, that growth comes out tax-free. For college, where these MAGA accounts with all of the details to be determined are intended to be tax deferred. So that's a big difference there as well, depending on your circumstance and what you're doing. And then another thing too that I just want to bring up really quick, not to go down the rabbit hole, but we do have a lot of parents with good intentions or grandparents gifting grandchildren monies into 529 and what I assume potentially the MAGA accounts. But you just want to be careful for not only understanding the potential restrictions, but then if you may qualify for financial aid, especially for some of these private colleges, you don't want to unintentionally disqualify the minor child for financial aid. So careful planning discussions really need to take place anytime you're putting monies into a minor account.
Absolutely, great points. Okay, so I think we'll move on to one of these big crazy animals called the SALT. So this is its own animal. We could certainly be here all afternoon on the topic of SALT, which stands for state and local tax. Of all the provisions in the One Big Beautiful Bill, this seems to be the one that is likely to change a lot in the Senate reconciliation, and it already has, according to what was issued last night in terms of the limitations. So I'll get to that in a second. So under the current law, the TCJA, what we finally refer to as the SALT, which is the deduction for state and local taxes, if you itemize, is capped at $10,000. So this mainly affects filers in states with higher tax rates, like New York, unfortunately, California, New Jersey, Illinois, Connecticut. The Big Beautiful Bill would raise this limitation, this SALT cap, to $40,000 for married couples earning up to $500,000. Then would gradually phase it down for higher earners. So it would remain at $10,000 for those with higher AGIs, but it phases down the $40,000 SALT cap at a rate of 30% for taxpayers making over $500,000. So this would take effect this year, not in 2026. The SALT cap would begin to phase down again for those with incomes above $500,000. Settling at the existing $10,000 cap for those making $600,000 or more. So, and then there would be it's proposed there would be a 1% annual increase in the SALT cap in the income threshold at which the phase down begins. So if you itemize, what does this mean for you? I mean, if you itemize deductions and live in a state with high income tax or property taxes, you could deduct more of those local taxes if you fall under the income threshold. So this is a really big ticket item in the bill, in the Senate version. The deduction is part of your overall itemized deductions. And again, just to recap, I mean, it includes a lot of things. The state income taxes paid during the year. So your withholdings, your quarterly estimated taxes you've paid, property taxes, sales tax. So this was previously not capped prior to this TCJA, then capped at 10,000 and now could go up to 40,000, but phase out rules will apply. And certainly some high income taxpayers could still stay at that $10,000 level. So, So we have another question. I'm going to read this one off. It's, should I be accelerating deductions now if I might qualify for the higher SALT cap? So the answer is it depends. If your AGI is near that $500,000 level, accelerating property tax payments or state estimated taxes into 25 could make sense. But again, this is very volatile issue, changing as recently as last night. So just something we want to watch closely before we make any big moves like that. All right. The proposed bill, I don't have this on a slide, but there are a couple other provisions with regard to energy tax breaks. So several of the clean energy incentives created by the Inflation Reduction Act passed by President Biden in 2022 would go away under the big beautiful bill. It includes the electric vehicle tax credit for certain EV purchases, home improvement credits for energy efficient upgrades, and several other changes to energy related tax credits. Just had a conversation with a client last week about a big solar project installment, and he's, after kind of suspecting this might go away, he's really going to start accelerating that project into 2025 in case these, deductions go away. So lots to think about there. We'll keep everyone posted as we learn more about what's going to become permanent. So another provision that we don't expect to impact many people because of the phase out level and just the limitations is this new car loan interest deduction. So it's a tax break in the big beautiful bill for vehicle owners. Again, this is one of those above the line deductions, whether you itemize or not, of up to $10,000 for qualified passenger vehicle loans each year. So if you make over $100,000 or $200,000 for joint filers, the deduction will phase out. The vehicle, there's a few limitations, must be manufactured mainly for use on public roads, have at least 2 wheels. So maybe even some motorcycles, be a car, minivan, SUV, pickup truck, even an all-terrain vehicle, a recreational vehicle, and have its final assembly take place in the US. So again, this is just like the tips and overtime provisions where this would be temporary and only available from 2025 to 2028. Again, these are just temporary. These are not the final tax laws, just basically the House's version at this point.
And then a couple of other changes as well that they're looking at when considering your overall taxes and savings is also to health savings accounts. So for those of you who do have a high deductible health insurance plan, especially a lot of small businesses, they are looking at increasing the contribution limit for both individuals and families. There's also phase outs for that, but definitely something to pay careful attention to. And they also want to extend use cases for HSAs. So if you are someone who is not cash flowing out of pocket your medical expenses, you can continue to use the HSAs for that, plus things like the gym membership. And then another note that not everyone realizes are these health savings accounts are a way to significantly reduce your taxable income, and you can invest it and save it for the future in retirement for tax-free income or tax-free bucket rather, to take withdrawals for medical expenses. So it is really important to pay attention to that. And then depending on your income and where they're going to have these phase outs, which they have not set them in stone yet for the increases, it's definitely something to take advantage of for not only now planning, but in the future, especially with the astronomical increases for how much healthcare really costs.
Yeah, absolutely. Excellent point. Lots of opportunities there. All right, so another big area, certainly for both Nicholle and me, I know we've talked to just dozens and dozens of clients on estate planning, really since, gosh, early last year when the thought of these, the TCJA sunsetting was really becoming a possibility and getting closer and closer, and needing to establish relationships with your professional team of advisors, your planners, CPAs, attorneys, before the rest of the world did. So what this slide does is it covers the current and proposed estate tax provisions. So I'll first explain kind of what the gift in estate tax is. So this is a transfer, tax on the transfer of wealth. Anything from the investment accounts you have, real estate, a closely held business interest, and it's a tax on the transfer during one's lifetime or at one's passing. So every individual has an exemption of the estate tax. You can transfer up to the exemption amount without incurring the tax. So 99% of us don't have an estate problem, but as I will mention later, we might have one on the state front. So, but under the TCJA, the estate exemption is $13.99 million per person. On married couples, it's $27.98 million that do not incur federal estate tax, which is currently 40%. So this is the highest exemption has ever been. The TCJA doubled this exemption amount. At the end of 2025, it is set to revert back to the amount at 2017, which is going to go, potentially, it could go from around this $14 million level down to $7 million. So very, very hot button issue, lots of draft proposals, which is the provision to increase the exemption to $15 million per person, $30 million for married couples, and then made permanent. So that's the current proposal in the One Big Beautiful Bill. So we'll definitely be keeping an eye on that and issuing more guidance as we get it. So there's about a dozen or so states that do impose their own separate state estate tax. In the Northeast alone, many of these states have their own estate tax regime. These estate tax exemptions are lower, considerably lower. So New York's, for example, is $7,160,000. So again, while most people don't have a federal estate problem, we're meeting more and more clients that have come to realize with our help that they are, they're surprised to learn that they could actually be impacted by New York State estate tax. So lots more to come on that. And like I said, as we know more. So what do we want to consider now? Start planning now. Start planning now. I mean, even though this $15 million exemption could actually be the case, it's never too late to do really effective and important strategic estate planning. Whether the exemption changes or not, you still don't have an estate tax problem. Anything from ensuring that your final wishes are known, that all of that's addressed, from POAs, healthcare proxies, funeral wishes, I mean, you name it. There's just so many other estate planning matters that people don't think of as estate planning matters, but are. And either Nicholle or I, or both of us, can help you start that conversation and would be happy to help.
Yeah, and a thing to keep in mind as well is even though you might be outside of the estate tax, your kids or who inherit your money, if it's a taxable asset, it could really be harmful to them potentially, especially if they're in their highest income earning years and they're inheriting a very large pre-tax IRA, 401k, and they're forced to take distributions out of that. It's always good to give money, but they could be losing quite a lot more to taxes than actually keeping it. And that is typically no one's goal. So being proactive in planning now, whether you have a taxable estate or not, I think is a really good idea. So that's why those Roth conversions are highly important to consider if it's a fit for you. When a child or anybody inherits a Roth, there isn't a tax consequence like pre-tax accounts. And then thinking about life insurance, and if your life insurance is more of a wealth transfer mechanism, to maybe consider putting that into an irrevocable life insurance trust, getting it outside of your estate altogether. And then depending on the size of your estate, there are many different types of trusts that we can talk about that are higher level planning, but really important to, again, keep more money in your family, less money being paid to the government. And these numbers sound high, 50 million, 30 million potentially, but if you are young and depending on where your assets now, that compounding growth and interest over time, it adds up really fast because it's not just your investment accounts, the value of your business, the value of all your life insurance policies and what those will be worth in future times. And many of you on this call have another 30, 40, 50 years. And so those numbers add much quicker than you think. And so we're constantly looking at that and the likeliness that it could occur and just protecting against it or being strategic rather so that you can still ensure you're doing what you want now without a lot of stress, but always making sure that wealth transfer is as tax effective as possible, whether it's to family or of course a charity.
Absolutely. Awesome. All right. So again, this section of the presentation of the One Big Beautiful Bill, the business provisions, can and actually probably will be very soon its own webinar. So we're looking forward to that, to really dive deeper into some of, the really important matters for our business clients. So big or small. So they're really top of mind for our business clients, especially those that are pass-through entities. With regard to the 199A deduction, the PTET, bonus depreciation for all of our businesses. So we'll start with the 199A, the deduction for qualified business income. So there is going to be a change here, at least in the proposed bill with regard to QBI. So this was a new deduction that of qualified business income for pass-through entities, our sole proprietorships, our partnerships, our S-corps, and this is set to expire at the end of this year. But the House bill, the One Big Beautiful Bill, includes a permanent extension of the deduction with an increase in the deduction from 20 to 23%. And it also is going to proposes to modify the phase-out limitation. And a new two-step calculation for taxpayers exceeding certain income thresholds. So keeping us on our toes here. All right, so then we have bonus depreciation. So everyone's pretty well aware of this deduction by now. So it is in its phase out year right now, year 3 of the 5-year phase out of the bonus depreciation program. This year, that phase out level is 40%. So by the end of 2027, it will be gone completely if things don't change. So the TCJA had introduced a phase out until 2027 and eliminated. The new House bill would increase the depreciation deduction rate to 100% for property placed in service. Again, this is just proposed after January 19th of 2025. So backing up and kind of going retroactive pretty much to the beginning of the year. And I believe that was the day before Inauguration Day. And so again, it's for property placed in service before January 19th of this year and before January 30th of 2030. So again, timing is everything here. Timing of acquisitions will be key in order to take advantage of the maximum deduction available. We'll cover the R&D expenses once things get more solidified. We don't have enough time to cover that today, but there's going to be some really good news, I think, on the R&D expense front. So we'll be presenting a business tax update soon, as soon as some of these provisions are solidified. But again, please feel free to drop in the question section, even the business tax topics that you want to learn more about so that we really know what topics to focus in on for you. Okay. Again, another major topic here is going to be this pass-through entity tax, or what we always finally refer to as the PTET. The One Big Beautiful Bill will restrict the ability to use the PTET election to only allow partnerships and S-corps that qualify for the qualified business income under 199A to utilize these workarounds for tax years beginning after 2025. These restrictions are not in place currently, so this is new and a very controversial area. In addition, certain professional service providers, such as athletes, medical professionals, investment vehicles, accountants would no longer be able to take advantage of the self-cap workaround, the PTET. So lots that we're keeping track of there. All right, so the statement describes a proposed change in legislation regarding the pass-through entity tax election and its connection to the QBI under the 199A of the Internal Revenue Code. So again, just to recap, the PTET is a mechanism enacted by many states as a workaround to the federal limit on the state and local tax deduction for individuals. So the pass-through entity, again, the partnerships, the S-corps, can and still can elect to pay state income taxes at the entity level, which effectively allows their owners, those pass-through owners, to deduct those taxes without that $10,000 SALT cap. So it stays out of that itemized deduction realm. So it allows eligible taxpayers to, the QBI, on the other hand, is the federal deduction that allows taxpayers to deduct up to 20% of their QBI, which comes from pass-through entities like partnerships and S-corps. All right, so there are workarounds There's going to be effects to the availability of the PTAT workaround to only those eligible for the QBI deduction, certainly potentially limiting that use for partnerships and S corps that don't need the QBI requirements. So again, this could be its own webinar, but I can assure you that as these changes unravel, we'll be right on top of it and be more than happy to hold more of these sessions to keep our business owners informed and really just planning, being that we still do have quite a bit of the year to go. So in a way, the sooner this legislation gets passed, the better, so that we can really start jumping on some really solidified projections and planning and financial planning for everyone. And I just wanted to note that on my LinkedIn this morning, I did post a summary of the Senate proposed changes. So that along with our firms, both of our firms' social media pages will be where a lot of updates will be posted. Certainly, any notifications of future webinars and meetings like this. So I'll pass it back to you, Nicholle. I'm sure you have a lot more insights to share. You always do, and certainly helpful in planning for the rest of this year.
Yeah, I mean, I think the reality is we're both trying to stay as informed as possible, putting everything on social media as soon as we have it, and just having regular conversations. And, if you are a business owner, it will be important to definitely take a look at your entity type. What are you paying yourself? If you have rental properties, another thing that we'll want to be looking at, especially with some of the depreciation, and if any aggregation strategies make sense to you, cost segregation. I know I've been getting a lot of questions on that. I'm sure you have, Lisa, but these are all things that we want to talk about. But also, I just want to caution, I'm bringing this up because with rental properties, I also get a lot of people that say, I saw it on TikTok. And TikTok doesn't always have all the nuances and details, and so you always want to make sure that you're taking into consideration not just this year, but all of the years in the future, and that you aren't setting yourself up for any unintended consequences. Really important. But a couple of things too, just as like endpoints that aren't necessarily related to the PTAT changes or some of this depreciation, but I did want to make a note because this is a change that happened this year and not relevant necessarily to the new tax changes, but will be important depending on where you're going to fall in the tax brackets for some of the increased retirement plan contributions. So it is for 401k, you can do up to that $23,500 pre-tax or Roth. There's not an income phase out for Roth 401k. So that is, again, something that comes up quite a lot that is misunderstood. And new is now, if you are between the ages of 60 and 63, you have an enhanced catch-up. So that's an additional $11,250 if you're in that age range, whereas, if you're over 50, you typically have that $7,500 amount. And then heading into next year, if you're considered highly compensated or a business owner, your catch-up contribution will be mandatory Roth, which means it's good news for future you because it'll be tax-free distribution, but something to definitely make sure that you're aware of if that is going to be a potential tax bracket change for you if you're used to having that as pre-tax right now. So again, we're midway through the year, so it gives you the rest of the year to maximize those strategies if you want to, need to, with some other things going on, but then importantly heading into next year with some things that we'll just want to have on our radar.
Awesome. Great. Well, I think that then moves us into the Q&A. If anybody has any questions, feel free to put them in the question section and we'll get them answered. We've answered a couple along the way, but if there's any remaining questions. Also, too, just wanted to provide Lisa and Nicholle's contact information and thank you for having them join us today. You can also get to the Tronconi LinkedIn page here and some of our other past webinar recordings. Like I mentioned, you will get an exit survey when you log off today. Let us know how we did, if we answered your questions, if you'd like a meeting set up with Lisa and or Nicholle. And then I will be emailing you either later today or tomorrow morning a link to the recorded session. Again, another copy of the presentation and handouts. So We want to thank everybody for being with us today. We're ending a little bit early, unless any other questions came in. Lisa, did you see
I
anything?
don't have anything else. No,
Okay, great.
Anything else?
Okay, well, everybody is fully understanding this, and I'm sure we look forward to more webinars on this topic and updates through webinars and LinkedIn posts. So thank you, everybody.